Very good evening once again. Hope you are all doing great. So we will continue with what? PGBP, Profit and Gains of Business or Provision. We have been covering so many provisions of PGBP. So in last class, we had actually covered about various sections relating to your 36, where we spoke about other deductions. We also discussed about 37, section 40, and section 40A, right? So we discussed about various things. So in this session, we'll continue from where we left on. We have few more sections in PGBP before we wind up PGBP. So the next section that we'll be talking about is something called 41. It's basically called as profits chargeable to tax. In other words, we can call it as deemed income, which means these transactions are not recognized as income in the books of accounts in that particular year, but it is considered to be deemed income. If you want a small example, we'll have to go back to the previous class. We were talking about the term bad debts under section 36. We said bad debts is allowed as an expenditure. You need not prove anyone that it is supposed to be not recovered. So you need not prove it anyone. It is a bad debt. So that's all it is about. As long as it is an income in the previous year or some other earlier previous year, it can be recognized as a bad debt. And we said when it is subsequently recovered, when a part of it is subsequently recovered, and when that recovery is excess than what has been allowed as the difference between your debt and the bad debt, we said that will be treated as an income. We took some example also, right? So we understood this with an example. Now, in this scenario, similar cases is what we are going to talk in section 41. So which means it is actually not a book income into the books of accounts, but it is considered as a deemed income. When you say it is not recognized in the books of account, probably you are trying to say it is not in your regular business operations. It is not in the manner of regular business operations. So it is something specific in that year. Something specific has happened in that year. So first thing, as we said, we have already discussed about bad debts. We also discussed about this assets relating to this scientific research where we can treat something as deemed income. So now what we are going to do is other two clauses here, which talks about, first is one which talks about remission or cessation. So when you say cessation, what do you mean by cessation? Cessation means the word stop. So probably it's something like it is no more a liability. It is no more a liability. So what are they saying? They're saying it is basically an allowance or a deduction. It has been provided in any year. In any year, it could be related to loss or in expenditure or trading liability. So let's take some creditor, something in creditor, which means you're supposed to pay. It is nothing but reverse of bad debts. Now in bad debts, when your debtor is 100, you are saying that you will not be able to pay 40. For example, in bad debt, let's say your debtor is 100. You say that bad debt is 40. You recognize this, right? You recognize this as your bad debt. You recognize it as an expenditure, correct? You recognize it as an expenditure. Now let's take creditors. Creditors, there is 100. Now you are calling something not payable. Not payable 40. Now what does this 40 become? What does this 40 become? This 40 becomes deemed income. Why? Because earlier you said this 100 is payable by you. That is why the books of account considered as an expenditure, and that is why income tax also considered as an expenditure. But now you say it is no more an expenditure because I'm not required to pay, which means it becomes a deemed income in the hands of that particular person who is considering it as not payable. So this is what you're talking about 41.1, where you are saying the particular advance or deduction which has already been provided in any of the earlier years. It could be in respect of loss, expenditure, or any trading liability. So which means if that you say that it is no more payable, that is remission or cessation, which means you're saying it is no more a creditor, it is no more a liability. I stop here, I stop at this point, that it is no more a liability. So this transaction is what you are calling it as remission or cessation. So such amount shall be chargeable to tax, because it is nothing but it is no more an expenditure. It is no more a liability. So that becomes an income. So here business existence is not required. Similar to your bad debt, when you're subsequently recovering and something has to be done with respect to ultimate recovery, business existence is not required. So here also we are saying business existence is not required to say that it is no more payable. So that's what it is. That's what it means. It says business existence is not required. If business is succeeded, for example, it is taken over from one hand to another hand, let's say father to son or something. So in that case, whatever was supposed to be a liability of father, if it is no more a liability in the hands of the son, if son says, I'm not going to pay this amount of what father owes, then that income is taxable in the hands of son. So when it is in carrying over by succession, that is in the subsequent generation or subsequent point of person, then it is supposed to be considered as an income in the hands of the subsequent person, in the hands of the successor. So that's what it is considered to be the in the hands of successor. And then the next one is adjustment of losses. What do you mean by that? You say the business is no longer in existence, so which means you add a business in which you had incurred various expenditures or whatever it is. Suddenly today you say the business is no more in existence. So which means if there is an income, if there is you add a loss in the year in which it ceased to exist. So you add a business loss in the last year of operation. Let's say you wound up your business in financial year 2018-19. Let's say you add your business in previous year 2018-19 closed with a loss, let's say 10 lakhs. Okay. Now what the provision says is there is an income chargeable in the current year. So in the current year, when your business is actually not there, let's say previous year 2021-22, when your business is actually not there, so it is already closed, no existence, correct? No existence because it's already closed. Now let's say you have income from 41.1, that is remission or cessation, and then you have income from 41.3, that is sale of capital asset under section 35, that is which has claimed benefit under section scientific research, and 4, which is bad debts recovered. So if these three things, that is 1, 3 and 4, 41.1, 3 and 41.1, 3 and 4, if you have an income from this, let's say you have an income of 4 lakhs. Now the provision says this 4 lakhs can be adjusted with loss of previous year 18-19. So this can be adjusted. So that's what it's an adjustment of losses. So such income can be adjusted against such loss. The only condition is what? It should not be in the nature of speculation business. Otherwise, whatever your deemed income can be adjusted with the loss of the last year in which business ceases to exist. So that's what you are actually talking about, correct? So it can be adjusted in the last year in which business ceases to exist. So that's all about your what? Your deemed income. So that is about section 41, which is deemed income. Please understand what we have discussed here is only 41.1, which is relating to remission or cessation. But in the earlier class, we have already discussed about the scientific research income and bad debts income, deemed income under these two sections, under section 35 and under section 36. So these are bad debts related income. So this has already been discussed. So that income along with this remission or cessation is eligible to be considered as an income and adjusted against the loss of the last year in which the business ceases to exist. So that's what the provision is about. Clear? So that's all about section 41. So now we'll move to section 43B. Okay, so 43B is a very beautiful section, like every other section. So all sections are beautiful. 43B is one another beautiful section. So what does it say? It says deduction is allowed only on actual payment. So what is the word? Actual payment. But earlier under section 145, what did we say? What did we read? We said that for a business income, the income can either be accounted on cash basis or mercantile basis, right? So for PGBP and IFOs, the income of the assessee can either be income, that is, when you say income, that is accounting of the assessee can either happen on cash basis or mercantile basis. So what do you mean by mercantile basis? Mercantile basis means that it is on accrual basis. So even if you have not actually paid something, you still record it in the books of accounts. But income tax says, I'm very happy with your books of accounts. You have always followed accrual system. I appreciate due date. So what could be the taxes or duties? It could be your income tax, it could be your GST, it could be your customs duty or whatever duty you are talking about. It could be your education cess, it could be any fee that you are talking about. Whatever it is, government says it is my income. Please make sure you are paying it on time. If you wanted to claim it as a deduction, please make sure you have paid it on time. I mean, what do you mean by time? Time is nothing but due date of filing return of income under section 139(1). Correct? So that's what the government says. That's what the provision says. So why is that? Because government wants its share of income within time. So that's the first point. That is your taxes. Whatever taxes you wanted to call, you can call that. The next thing is employer contribution. We were talking about employer contribution and employee contribution. In this, I would like to make a mention when we are talking about the term employee contribution, right? Employee. It is due date of what? Of relevant act. For example, if you are talking about PF, the due date is 15th day from the close of the month. So if it is, we are talking about May 2022, the due date is 15th June 2022. So if you are not paid employee contribution, some of you asked, why is there such a stringent provision only for employee contribution? I told you an answer. What did I tell? It is employees' money. It is employees' money. It is not your money. It is not company's money. It is employees' money, which I am keeping it in my hand. So I am not supposed to misuse employees' money. So the provision says you are not supposed to play. I am okay if you are playing with your own money. Your own money, you can pay it later. You file it, you pay it before due date of return of filing. But if it is employee share, please make sure you pay it on time. So earlier there was dispute in this particular provision. Some thought for both employee and employer 43B applies, which means before due date of filing return of income. There are various judicial rulings also to support this view. So government said, see, that is never my intention. Whatever the court is saying, it is blah, blah, blah. My intention when I introduced the law was very clear. You cannot misuse employees' fund. You play whatever you want with your money. I am least bothered. But if it is employees' money, pay it on time. What does time here means? The due date under the relevant act. So the government was very clear. They have clarified it in Finance Act 2021. So now the provision is very, 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 very clear. What does the provision says? If it is employee contribution of PF or whatever it is, it must be paid within the due date of the relevant act. There is no employee contribution gratuity and all. So we are talking primarily about provident fund only. So whatever provident fund contribution of employee must be paid within the due date specified in the relevant act. So that's an amendment in Finance Act 2021. Now coming back to 43B. 43B now only talks about employer contribution, not about employee contribution. So what does employer contribution says? Whenever there is an employer contribution towards provident fund or superannuation or gratuity or whatever fund it could be, they say, I am okay you paying it little late, but make sure you are paying it within due date of return of filing under section 139(1). Correct? So that's the second thing. So the first thing is tax duty. The second thing is employer's contribution. Third thing, bonus commission not being distribution of profit. We already saw in section 36, we said if it is bonus or commission not being in the nature of profit distribution, it is allowed as an expenditure. Now it says you cannot book bonus or commission to the employee as payable. It cannot be accrued. You'll have to pay it before due date of filing return of income under section 139(1). So I'm stressing this line, pay before due date of filing return of income before under section 139(1). Why am I stressing this sentence repeatedly? Because it's very important. What requires is payment, not payment before 31st March or due date of the relevant act and all. The due date that we are specifying here, the payment we are specifying here, should happen before the due date of filing return of income under section 139(1). Please be clear on this. So the third thing that we are talking about here is bonus or commission not being in the nature of distribution of profit. Do you want me to tell you why bonus or commission should be paid and not just booked as payable? Why? Because bonus is an additional benefit, or even commission for that matter, is an additional benefit given to the employee for working extra, for doing more, for making more sales, for doing more work. So this bonus or commission is an incentive. It's an added benefit given to an employee. So it is something that is due to the employee. So government says whatever is due to the employee, please make it immediately. At least if you're not able to make it immediately, make it before the due date of filing return of income. So that is the reason. Again, it is the employee's money, kind of employee's money, the bonus or commission. The fourth one is interest on any loan. When you say any loan, what is the loan that we are talking about? Any loan, but who is the provider of the loan? It can be any public financial institution or a state financial industrial corporation. Again, it is like a government. It is like the government. So pay interest to the government on time. And any deposit taking NBFC or systematically important non-deposit taking NBFC. So when you say systematically important non-deposit taking NBFC, these are NBFC. What do you mean by NBFC? NBFC stands for non-banking financial corporation. So what do you mean by non-banking financial corporation? When you say non-banking financial corporation, is typically a bank which is not the name that we are talking about, not like State Bank of India, HDFC or something. It is a company, it is a corporate that is running banking services. So typically when you say banking services, they cannot have savings account and all. So you cannot go and open a savings account or a current account in the bank. They provide you loan or sometimes they accept deposits from public. So the one NBFC that we are talking is accepting deposits. The other NBFC we are talking is not accepting deposits. So typically a systematically important non-deposit is basically who are holding public deposits, to the tune of less than 500 crore, not less than 500 crore. So which means if there is an NBFC, which is any deposit taking NBFC or systematically important non-deposit taking NBFC. So when you say non-deposit, so we'll write about NBFC first. So NBFC, what is NBFC? Non-banking financial company. Okay, non-banking financial company. In this, we are talking about two. One is deposit taking. Another is systematically important non-deposit taking NBFC. So what do you mean by that? A non-banking financial. So here it is whichever is accepting public deposits. Here their total deposits is greater than 500 crores. Total deposits in the balance sheet date, in the last balance sheet date, is more than 500 crores. In that case, they become a systematically important non-banking financial, non-deposit taking NBFC. Sorry. So that is the next thing. So that is also not allowed. So that is interest should be paid to them also. Why? Again, the loan given to you is from public deposits, right? NBFC is not giving their own money. They are giving money of public deposits. So again, government says, see, these are public money which is being lent to you. So please make sure you are paying it before the due date of filing return of income under section 139(1). And then you have cooperative bank, a scheduled bank or a cooperative bank is also referred here. So what do you mean by scheduled bank? All your banks, like your state bank, your Indian overseas bank, your Indian bank, whatever is a scheduled bank under this under the government of India. So those are all called as next category. And then your cooperative bank. The only cooperative bank which is not included is primary agriculture credit society or a primary cooperative agriculture. So how do you remember this? You have to remember all banks, but for relating to agriculture, relating to primary agriculture. So if the bank name has this word, primary agriculture, if it has this name, then it is okay. 43B does not apply here for that particular interest, primary agriculture. So that's what it is. So that is for primary agriculture. For others, it is scheduled bank or a cooperative bank. Interest must be paid on time. Conversion of loan. Okay, I'll stop here and first explain these three. So what did we say? Interest on loan on any public financial institution or state financial or industrial corporation. So that is the first thing. And then we are saying any deposit taking NBFC or significantly important non-deposit taking NBFC. So this is the second thing. The third one is any scheduled bank or a cooperative bank other than the primary agriculture related banks. That is primary agriculture credit society or primary cooperative agriculture rural development bank. These are the things that are not considered. That is primary agriculture related things. So if you're not paying interest on time, please remember all these three things represents either the money, interest money is payable to the government or to a bank which has distributed public funds to you. So that is why it is critical. So that is the reason why it is important that it must be paid on or before the due date of filing return of income under section what? 139(1). Clear? So that's the one thing. So now we'll move on to the next concept. Till this, it is interest. Now we are moving to a separate point. What are we saying? We are saying conversion of loan shall not be deemed to be paid. What do you mean by conversion of loan? There is some concept called funded interest term loan. They call it as FITL. It is called as funded interest term loan. What do you mean by that? You continue to pay interest, correct? Now let's say interest is unpaid for 12 months and that amounts to 12 months and that amounts to how much? Let's say it amounts to 50 lakhs. It amounts to 50 lakhs. Okay, so this amounts to 50 lakhs. Now the company says, see, I'm in a very difficult situation. I have a huge impact due to COVID. Why don't I pay this over a period of, let's say, 50 months. I'll pay 1 lakh every month. Now my business is picking up. COVID and all has gone away. So I'm not bothered about whatever it is. Now I have opened back my all this business. So now my business is going well. I can pay now. But please understand, whatever you're calling it as interest money, I'll pay it over a period. So for 50 months, I'll pay each month 1 lakh and I'll set to 50 lakhs. Now the provision says this conversion of 50 lakhs is not payment. So what do they say? They say conversion is not payment. Conversion is not payment, but subsequent payment, that payment of 1 lakh during subsequent period, I'll call it a subsequent payment. Subsequent payment is payment. Okay, so the conversion is not payment, but subsequent payment is payment. So that's what these two lines are. It says conversion of loan shall not be deemed to be paid. So the conversion of loan, that amount is not eligible under 43B, but unpaid interest, whenever paid, will be allowed as revenue expenditure. This is in the books in the name of what? In the income tax angle. In the income tax angle, what we are talking is not accounting. So please don't think what will be the debit, what will be the credit and all. We are not going to talk about it. What are we going to talk about it? What is allowed, what is not allowed from the angle of Income Tax Act 1961. Clear? So what does 43B says? 43B says, if you have certain expenditure, I will allow it only if you have paid it on time. What do you mean by time? On or before due date of return filing under section 139(1). Correct? Okay, the next thing, that is the fifth thing that we are going to talk about is earned leave. So earned leave is something like your leave encashment. Whatever leave encashment to an employee should also be only on paid basis. So only if you have actually paid. So again, why it is employees' money? It is employees' money. And finally, paid to Indian Railways for the use of railway assets. So whatever you are supposed to pay to IRCTC for using railway assets. So what do you mean by railway assets? You are using the coaches for transporting the goods of the company. You are using some of the assets of the IRCTC. So whatever IRCTC, be it the train, be it the track, you are using the track to run your own train, to deliver some goods into your own factory. So that railway track belongs to IRCTC. So whatever assets that you're talking about of IRCTC, if it is used by a company for whatever payment they are supposed to make, it is allowed only if you have actually paid. Again, IRCTC, why is it important? It is the government. It is a government statutory organization, so it is important. So that is why these six things are allowed only on payment basis. What do you mean by payment basis? If it is paid on or before due date of filing return of income under section 139(1). Okay, so what are the 6 items? Any taxes, because it is government's income. Any employer contribution, because it must finally go to employee. And any bonus or commission, because it must go to employee. Any interest on any loan, because it is also kind of government's money or public money. Government's money or public money. Earned leave, why? It belongs to employee. Paid to Indian Railways for use of railway assets. Why? Because it belongs to government money. So it is either belonging to government or to the employee. Please understand, these 6 things either belong to the government or to the employee. So because of that only we say it must actually be paid even if you are following mercantile basis of account. So that's what you're actually calling it as actual payment, deduction on actual payment. Clear? So that's about section 43B. So we have a small illustration of 43B. So I will go through this and then proceed further. So Hari, an individual, carried on a business of purchase and sale of agriculture commodities like paddy, wheat, etc. He borrowed loans from Andhra Pradesh State Financial Corporation. So what does the word says? The word says Andhra Pradesh State Financial Corporation. So it is a state financial corporation. And then Indian Bank. Indian Bank is a scheduled bank and has not paid interest. So he has not paid interest. Who has not paid interest? Hari has not paid interest for previous year 2021, previous year 21-22. So for 2 years, he has not paid interest. How much is that? 15 lakhs. For Indian Bank, it is for 1 year only. For 1 year only, it is 30 lakhs. So this 15 lakhs and 30 lakhs, these are the 2 things that we are talking about, the 15 lakhs and 30 lakhs. Now, both AP SFC and the Indian Bank, while restructuring the loan facilities of Hari, what did we say? The loan might be turned into another loan. The interest alone could be converted as a loan. So what are they saying? They are saying, repay me in 60 equal installments. 60 equal installments during the year ended 31/3/2022. Now, during the year ended 31/3/2022, that is financial year 21-22, Hari has paid 5 installments to APSFC and 3 installments to Indian Bank. So 5 to Andhra Pradesh, 3 to Indian Bank. So that's what they have paid. Now, what has Hari done in his return of income? Hari says the entire 45 lakhs is actually converted into loan. The entire 45 lakhs is now converted into a loan itself. So the interest is kind of paid. Hari says it is actually paid because it is converted into another loan. So we need to tell Hari whether his claim is valid or not. So we have to guide Hari. As a chartered accountant, we all must guide Hari to tell Hari whether whatever stand he has taken of claiming the entire 45 lakh is correct or not correct. So what do you all think, whether correct or not correct? So what did we read in the provision? What did we read in the provision? We read in the provision that conversion of interest into a loan is not considered as what? Is not considered as paid. Correct? Not considered as paid. So that's the thing. And then we said when unpaid interest is subsequently paid, it shall be treated as paid. So now the 5 and 3, which we are talking about. So how do we work out now? We can work out as so what illustration is? Illustration 14. Okay, so I'll write it as particulars. So now I'll have to have interest outstanding, tenure. So let's say monthly. I'll have to know how much is monthly, paid for how many months he has paid. Let's say amount. You can name it in whatever you want. Just it should convey whatever you're working out. So first is Andhra Pradesh State Financial Corporation, and then you have Indian Bank, right? This was 15 lakhs. This was 30 lakhs, correct? So the tenure is how much? They said 60 months, correct? Tenure is 60. Where is it? Yeah, 60 equal installments. So tenure is 60 in both cases. So this will be how much? 25,000. This will be how much? 50,000, correct? 50,000. How much has he paid? 5 to Andhra Pradesh, 3 to Indian Bank. So this is 1,25,000. This is 1,50,000. So 2,75,000. So what Hari can actually claim? What Hari can actually claim is only what? What Hari can actually claim is only 2,75,000. That is nothing but 1,25,000 to Andhra Pradesh and 1.5 lakhs to Indian Bank. So that's what it is about. So clear about it. Pradeep Gupta, what I was trying to explain here in this previous year 1890 and 2122 is about that you are eligible to claim the losses earned in 1819. You are eligible to claim the losses earned losses made in 1819 previous year 1819. That is nothing but financial year 1819, because in that year you have closed the business. Subsequently in 2122, if you have this deemed income, you can adjust this losses earned in assessment year previous year 1819 with previous year 2122. So both year it is only previous year. What I am trying to say is 1819 you have made a loss, business was closed. 2122 you have subsequently received money, you have some deemed income for which you can adjust it against the losses made in 1819. Madhuri, tax includes what? Tax includes what? Tax basically includes your GST, your customs duty, or whatever taxes you pay to government, whatever name you call, whatever amount you are paying to government taxes. It could include TDS, it could include your what else? Your TDS, your PF, GST, your customs duty. If you have any other duties such as your excise duty, service tax, or whatever name you call it, if it is a tax paid to government, it is included. Pooja, yeah, you're right. Just like railway tracks, roads also belong to government only. But since it's only toll fee or something, we are not bringing it into the picture. So whatever we are talking about, the railway track, railway coaches, we are only talking about the railway assets. Preeti, if the interest outstanding of previous year 1920 is paid in previous year 2021, yes, it is allowed. So the point that what Preeti is telling and what probably I also would like to stress to use, as far as this 43B goes, it is disallowed if not paid, but it is allowed in the year of payment. So it is allowed in the year of payment. Similar to what section? where also we said that it is allowed in the year of payment. There was one another section that we discussed last class where we said it is allowed in the time of payment. So please think through till I answer the other questions. So I told you linking the sections is very helpful to understand your provisions better. Yeah, good. Akash, Neil, Sumit, Imanshu, Pooja. So all of you have answered it correctly. Whatever Hari stand is not taken. So as a chartered accountant, whatever you have said is perfectly right. It is not allowed as a deduction. The entire 45 lakhs is not allowed. What is allowed is only 2.75 lakhs. So very good. Pooja, why is this chapter too lengthy and too complicated? If you ask me this, probably my answer would be, see, this is the major point of source. So it's typically like your, what you call, business is the backbone of the entire industry, right? So most of the persons earn income from business and pay taxes. So business is very critical. So the business chapter has to be very clear to the point to tell you what is allowed and what is not allowed. Because in day-to-day of a businessman's life, there will be so many expenditures, so many complications involved. So income tax has to be very clear to the extent to say what is allowed and what is not allowed. So that's why this much of clarity. And as far as your intermediate, your knowledge can always be limited. Probably if you want me to tell you, I can tell you that the important sections will be what? The important sections could be 30, that is your rent, repair, insurance and all those things of building. And then you have 31, which is repair insurance of plant and machinery. And then you have 32, which is depreciation. Okay. When you say depreciation includes the additional depreciation. So that's what it is about. And then scientific research and all will not be much of your intermediate syllabus. 35 AD, the specified business also is a very rare phenomenon in your examination. And probably 36, we saw other deductions. Okay. In 36, primarily you'll be tested in what? You'll be tested in your employee PF. So that could be tested because there is a recent amendment in that. And then apart from that, any other basic expenditure, that is, we spoke about other than that, very less only. Maybe your security transaction tax or commodity transaction tax. These are very few things in 36 which is important. 37 is general deductions. So we told certain rules. What did we say? We said it must not be capital. It is not personal in nature. It is not covered in section 30 to 36. It must be for the accounting year. So it must be wholly and exclusively for the business. So these are the conditions to claim under 37. So 37 is a very general provision. And then you will have 40A, 1 and 1A. So what is it? TDS disallowance. So this is important in 40A. So I'm very specific in 40, what alone is important. And then you have 40B, which is what? Your remuneration, right? Remuneration and interest restriction. So that is also important. Then what? We said 40A. 40A, only two sections are important. 40A2 is what? 40A2 is related party. In related party, what you'll be tested is not with the relation and all. You'll just be said that there is this person to whom you are paid excess. So your portion is restricted to individuals, right? So as far as individual, what did we say? Relative of individual or an entity in which either the individual or the relative independently are combined as substantial interest. So that's the only thing we need to remember as far as this related party is concerned. So they'll tell you that this relation has you have had transaction in excess. So that's related party. This is cash payment. You should remember it is generally 10K. For transporters, it is 35K. So and then what? And then you have 43B. So these are all the only sections that are important for your for your examination. So probably, like, see, this is the most important sections. I would like to tell you that it's important for your examination perspective. You will be very minimally tested in if sections other than this. There's a very rare possibility, in fact, but otherwise it will be predominantly only from this section. So that's what about your provisions are about. So yeah, Akash Neil, TDS is not deductible unless it has been paid before due date. So that's what I said. The taxes that we are talking here also includes TDS. So TDS is also allowed only if it is paid before the due date of filing return of income. And also section 40 clause A, subclause 1 and 1A also tells you that TDS expenditure, if it is international, 100% of expenditure is not allowed, whereas it is domestic, it is 30%. So since there is a separate provision for TDS, that is what should be followed. So not the whole expenditure, only the expenditure to the extent of 30% in case of domestic payment, 100% in case of international payment. So that's what, when you say international payments to non-residents. So that's what it is about, 40 clause A and 1A, correct? So when I say 40A and 1A, it is 100% for non-residents, 30% of expenditure for domestic payments, correct? So we'll call it as residents. So that's what the 40A and 1A. So this one thing is what is important for your examinations. Otherwise, I think, yes, it is a lengthy chapter. So this, if you focus on these sections alone, probably you will be able to cover your examination point of view. Okay, so we'll move on to the next section. So other things, whatever I'm going to tell you, I'll tell you if something is relevant for your examination. This 43CA is a section. So the next section that we are going to cover is 43CA. So what exactly is 43CA? It is applicable to land or building not being a capital asset. So someone is doing a business, they have something in stock in trade, a land or building. Now they are selling their stock in trade. When they are selling, what they are saying is, when you're selling a land and building, there are two values. One is called stamp duty value. Another is actual sale. Okay. What do you mean by actual sale? It is called a sale consideration. So that is what it says. So what do you actually mean by the sale value? So for income tax purpose, what will be your income? That is nothing but your full value consideration for the purpose of your business will be actual consideration received. That is nothing but the actual sale amount, or value adopted by any authority. That is nothing but the stamp duty value. So whichever is higher, which means you cannot sell your property, you cannot sell your stock in trade lesser than the guideline value, lesser than the stamp duty value of the particular property. So that's what the provision says. Now we'll take an example. I'll just put a line here. Okay, now we'll just take an example. My sale value, okay, my sale value is 200. Now my stamp duty value in that area is actually 220. So now income tax says, treat this as your sale consideration. So whatever you treat as your income should be this number. But now let's come to a practical scenario. There could be various issues, right? Some issue with the property, something wrong about the property. So I'm not ready to pay the entire stamp duty value. I would prefer paying it less. So now income tax says, see, I'm okay you paying less, but make sure if value adopted is less than 110% of consideration received. So what is the actual consideration received? 200. So it says, take a upper limit, that's nothing but 110%. So now what will be upper limit? It will be 220. For convenience sake, we will keep this as what? 210. Okay. Now upper limit is 220. So now if you're adding 10% to the sale consideration, and now your stamp duty value is lesser than, correct? Now your sale consideration becomes higher. That is, the upper limit of sale consideration is higher than the stamp duty value. So in this case, what it says is you can treat this 200 itself. So in this case, you can treat 200 as sale consideration. Why? Because you're within that limit. I'm giving you a cushion of 10%. You are within that limit. So the provision says if your value adopted, that is your stamp duty value adopted, in less than 100% of consideration received or accrued, then consideration received or accrued only will be treated as an income. So that's the first thing. Now there is a new provision amended in Finance Act 2021 which says transfer of residential unit. Please understand this. The 110% will be 120%. The 110% will be 120% if it's a transfer of residential unit. That is, whatever I'm having as stock in trade, it's a residential unit. And I'm transferring this between 12th November 2020 to 30th June 2021. 12th November 2020 to 30th June 2021. Now, first time allotment of the residential unit to any person. The person who is buying from me is buying his first house. It's not, it's an additional investment and all. That is his first ever house that he's buying. And the total consideration is less than or equal to 2 crores. So a person is buying a residential unit between November 20 and June 2021, and he is buying it for the first time, first house for him. And then the value, total value of the property is 2 crore. Now the provision says it is not 110%, it is 120%. 120%. If you understand this provision, there is a corresponding provision in capital gain also. Probably you will not have no confusion in understanding that. Similarly, you also have a similar provision in income from other sources. So this one provision, understanding this one provision of 43CA will help you understand two other provisions in capital gain and in income from other sources. So it will be easy for you if you are understanding this one provision alone. It is very simple. What does it say? I'm supposed to sell my stock in trade. I'm supposed to sell at stamp duty value. If I'm selling it at lesser value, it is not allowed. But there is a cushion. What cushion? 110% of the consideration received. That's a cushion. If it is a residential unit sold between 12th November 2020 and 30th June 2021, and if it is a first-time buyer of a particular residential house, and the value is less than or equal to 2 crore, then the percentage will be 120% instead of 110%. So that's what it is about. So that's about 43CA. Now there is one more point which we need to understand in section 43CA. So 43CA says, take stamp duty value. The stamp duty value could be varying. Let's say I had an agreement and registration. My agreement was on, let's say, 10th June 2020. Okay, or I'll keep it as 10th September 2020. But I'm actually registering it on 21 April 2021. Okay. Now, the stamp duty value on agreement date could be 1. Stamp duty value on registration could be 1. Now, what do I follow? Which one do I follow? Should I follow the stamp duty value on the agreement, or should I follow the stamp duty value on the registration date? Which one do you follow? I could hear you all. We are already confused. Why do you confuse me more? There is already a provision which says 110%, 120%, a particular date, 12th November 2020. Don't even know how could someone come out with the date 12th November 2020. There could be any date, right? 1st April, 1st June. There are so many dates. Who can pick a date which is random? 12th November 2020, right? So you're already thinking, how could we all remember this date? Now you are coming and saying one more provision and asking me to remember which date. Should I remember the date of agreement or should I remember the date of registration? But that's what income tax is. Why? Because it has to be crystal clear. It has to be precise to the point to make sure nothing goes wrong, to make sure that an income is properly reported and disclosed as far as your government is concerned. So that's what law is about, right? So it has to be very crystal clear, to the point, to the specific point, right? So that's what it is about. So now, coming back to this, you have two dates: date of agreement, date of registration. Now, which date to follow? Should I follow date of agreement or should I follow date of registration? Now the rule says, if the date of agreement can be considered if at least part payment received in, let's say, prescribed mode. We all know what is prescribed mode, correct? What is prescribed mode? Account payee check, account payee draft, NEFT, RTGS, UPI, correct? So all these are credit card, debit card. So all these are called received in prescribed mode. So now if the part payment is received in prescribed mode, if it is received in prescribed mode, then follow date of agreement, which means it's a solid transaction, a sure transaction. But if it is through any other mode, that is typically in cash, then what happens? Follow date of registration. That's what it is about. So date of agreement to be followed if a part payment is received in prescribed mode. Otherwise, follow date of registration. So that's what it is about. Your stamp duty value, which one to follow? Should you follow date of agreement or date of registration? Now, to have a better clarity, I'll give you this problem to make sure that you are very clear. At the end of the slide, when I'm just shifting to another slide, I want you all to be very sure on section what 43CA is all about. So now the first one is the date of transfer. The actual date of sale is 1st September 2021. Okay. The actual consideration is 100. And there has been an advance received 10 through what? Through RTGS on 1st July 2021. So on that date, that is on date of agreement, the stamp duty value is 120. Whereas on the registration date, that is 1st September 2021, it is 130. There is a change. What did we say? The actual consideration, first thing that we need to understand is, should I take the date of agreement or date of registration? Now there is a payment, advance payment received in prescribed mode, RTGS. So what I need to take is date of agreement. So we'll have to compare 100 and I'll not write it here. So we'll have to compare this and this, correct? 100 and 120. Now, what should I check? I should check whether 110% of 100 is less than 120, is more than 120. Now, what is 110% of 100? It is 110. So 110 is still lower than 120. So the provision says the value consideration is 120. Why? Because even after considering 110%, stamp duty value on the date of agreement is higher than the actual consideration. So that's why we are taking 120. So that's the first thing. The second thing, this is also 1st September 2021, but he has received here in cash, 10 in cash. So now, should I take date of agreement or date of registration? So what is the first step? I want to understand, should I take date of agreement or date of registration? So it is in cash. So I have to take date of registration. So what I need to take is date of registration. I need to compare this and this, 100 and 130. Now, what should I check? Again, 110%. 110% is 110. So 110 is still lesser than 130. So what will be my price? It will be 130, correct? So my price, that is my full value consideration, that is FEC, will be 130. So that's the second transaction. What is the third transaction? 31st January 2022. Here also it is 100. 10 is received through RTGS. So now is it date of agreement or date of registration? It is date of what? Date of agreement, because 10 is received in a prescribed electronic mode. So now I have 100. Date of agreement is 109. So what is 110%? It is 110. So now my 110 is greater than 109. So what should I take? I should ignore 109. and I should consider 110. When I say I should consider 110, I actually should consider 100. I don't consider 110%. The 110% is only for calculation purposes, not the actual purpose. So what do I actually consider? I consider 100, the actual consideration. So it's only an upper limit to test whether it is reasonable, whether the deviation is reasonable. Now the next one, 31st March 2022, it's 100, full received cash on registration. So which means straight away date of registration. So what will be taken? 130 will be taken. So there is no question. Date of registration, 100 or 130. 110% of 100 is 110. 110 is still lower than 130. So I'll have to take 130. So that's what it is about. Next one. Next to two things is for residential unit. And the date is 1st May 2021. So what was the period? The random date. 12th November 2020. 12th November 2020 to 30th June 2021. How random, right? I still couldn't understand how randomly they picked 12th November 2020. So this 12th November 2020 to 30th June 2021. Okay. In this period, you have actually transferred. Now I'll make it even more simple in your for your examination. Your examination is about financial year 2021-22, correct? So that's what your examination is about. So in your examination period, the relevant period is 1st April 21 to 30th June 21. So this is the period relevant for your examination, correct? So this is the relevant period for your examination. Anything before that is 12th November 2020 to 31st March 2021 is not for your relevant examination period. It is the previous period. So how far you might be tested? Probably very less. So that's what it is about, because most of the days will only fall between financial year 21-22 for your question. So you need not remember some random date. You could probably remember April 21 to June 21. So now this is May 21, which means it is within that period, within that defined timeline of April 21 to June 21. Now the first one is 150 is the cash amount. 50% is received in account paycheck. So what do you take? Step one, I'll have to take date of agreement. So how much is date of agreement? It is 180. Now 180, 150 into 120%. Why? Because it is a residential unit. It is assumed that it is the first time allotment. It is less than 2 crores. It is less than 2 crores. So considering that all four requirements are satisfied, I'll have to apply 20%. So how much is 20% of 150? 180. 150 into 120%. So I add 30. So 20% of 150 is 30. So 150 plus 30 is 180. Now 180 is equal to this date of agreement. So now what can I consider? I can consider 150 itself. Why? Because now it is equal. My stamp duty value is equal to this actual consideration. So I can actually consider 150 itself. The next one is 250. It is more than 2 crores. It is more than 2 crores. So I cannot apply 120%. I can apply only 110%. So I have now received in cash. So whether date of agreement or date of registration, I have received in cash. So the relevant date is date of registration. So the date of registration date is 285. 10% of 250 is 275. So 250 into 10% is 275. So here I'll have to take 285 only because it is lesser than that. So that's what your provision is about. So any doubts in this? So any doubts typically in this? So that's what it's about. So I'll see if I have some questions or something. If not, I'll move on to the next section. Why did they implement probably? Is this 120%? Is it what you're asking? Bharat, Himanshu, all the question is about the period only. As I told you, it is typically a period where they're giving extra benefit to the company who are selling. Probably we'll keep it this way. There is some slump in real estate. So the income tax wants to promote more selling. So they wanted to increase more selling. So income tax says to the company, I am okay if you are selling it less than stamp duty value to the extent of 20%, to the extent of 20%. So I'm okay you selling at a lesser value, but you don't sell it to everyone. Sell it to persons who are planning it to buy for the first time. So they are restricting the benefit given to the company. So the benefit is only given to a specified people who are first time buyers, which means they are buying a house for first time. So they are trying to meet the dream of buying a own house. So that benefit is only given to that specific person, and the cushion is increased to 100%. So it's an extra benefit given for first time home buyers. Imanshu, what do you mean by first time allotment? It is not giving up. This is the first time I am buying a house. Yeah, you have mentioned that also. You are a buyer for first time. You are actually a buyer for first time. So this is the first time you are buying a home house. So you are making your dream come true of owning a house. Most of them will have a dream of owning a own house. So that dream, you are achieving it. So the limit of 2 crores is because they don't want to give this benefit to rich people, right? So probably if someone is buying a house more than 2 crores, they're all rich people, probably, right? So that's what you could actually call. So you don't want to give that benefit to them. So that's why you're restricting it to only property less than 2 crore values. Why it is 150 in the fifth case? See, in the fifth case, the residential unit, whatever we are talking about is, it's a residential unit and it is less than 2 crore and the period is between the April 21 to June 21. It is within the specified period. So now the limit is 120%. So 120% of 150, 120% of 150 is 180. Now this 180 is equal to the stamp duty value on the date of agreement. It is not greater, correct? Your stamp duty value is not greater. What did we see here? We said if value adopted is less than. Now what is happening here? 180 is less than 180. Is this correct? No. 180 is actually equal to 180, correct? So now, yes, I am okay. So this is why we are saying you take the actual consideration of 150 itself. You take this itself as the actual consideration. So that is why you should be 150 because 120% of 150 is not greater than 180. It's not greater than 180 on the date of agreement. So I am ignoring the 180 here. I am considering this 150 on the actual consideration. Correct? So hope it is very clear on why it is 150 and not 180. So because it is within the range of 120%, it does not exceed the range of 120%. So that's the exact word. It has not exceeded the range of 120%. Since it has not exceeded, I'm considering the actual consideration itself and I'm ignoring the date on the agreement. So that's why it is about. Okay, so that is section fifth thing. So with this, we'll move on to the next topic. Next topic is about 44AA, that is to understand who all should maintain books of account. So basically, there is specified profession. So as I told you, profession is not defined under the Income Tax Act. Only thing is Section 2, Clause 14 says profession includes vocation. Profession includes vocation. So, but what exactly is profession? Section 44AA lists certain areas as profession. What are these areas? Legal, medical, engineer or architecture, accountancy, technical consultancy, interior decorator. All these are called as specified profession under Section 44AA. Now, apart from this, the provision says some other profession can be notified by the government. Some other profession can be notified by the government. What has actually been notified is film artist, company secretary, and information technology professionals. That is your software professionals or IT professionals. So these have been notified. So what do you mean by film artist? It could be an actor, dancer, director, singer, music producer, whatever it is, right? So film artists include each and every entertainer in the media industry. So that is called as film artist. So film artist, company secretary, information technology profession has been included as professions under Section 44AA. Why is this relevant to know what is profession? Who are all called as professions? It is important to understand about maintaining books of account. Should someone maintain books of account? When should someone maintain books of account? So probably we are going to understand who should maintain when should they maintain books of account? So that's what we are going to understand in this particular section 44A. How are we going to understand? We are going to understand it separately for professions, others. So as far as profession, the books has to be maintained. What books has to be maintained? Cash book, journal, carbon copies of bills exceeding 25 rupees. Imagine the amount, right? 25 rupees. Almost every invoice that you're raising will be more than 25 rupees, because 25 probably could have been written in 1961 also. Who knows what it is about. So this 25 is a very small amount. So technically we can keep it as all the bills and receipts should be maintained. Similarly, amounts received, that is your payment or something, exceeding 50. So copies of bills receipts issued exceeding 25. Original bill receipt received exceeding 25. So more than 50, you should have the original. More than 25, you should have the copies. So that's what it is about. If you are medical, you should also maintain daily case register and inventory of stock of the drugs that you are maintaining. So these are something very typical, very specific to medical profession alone. Where should they maintain this books of account? They should maintain the principal place of business or place in which carrying on business. Let's say my corporate office in Mumbai, I have a place of business in Chennai. I should maintain books of account relevant to corporate office there, relevant to here. So I'll have to maintain books of account in the principal place of business or place of carrying on business wherever it is possible. I could maintain in both places also, or I could maintain in one single place also. For how long should I maintain books of account? I should maintain it for a period of 6 years from the end of relevant assessment year. From the relevant assessment year, I'll have to carry it for the 6 years. So if I'm talking about previous year 21-22, it is about assessment year 22-23. So from assessment year 22-23, 6 more years. So 24, 25, 26, 27, 28, 29. So I'll have to maintain till assessment year 28-29. So that's what it is about, 6 years from the end of relevant assessment year. Now, who all should maintain? This is what we have to maintain, right? What has to be maintained is about this. Now, who should maintain? If it is a newly set up business, if they think the gross receipts will be more than 1.5 lakhs in the year. So your gross receipts during that year, if you think it will exceed 1.5 lakhs, you will have to maintain. For other thing that is already existing professions, continuously, that is for the 3 years, 3 immediately preceding previous year, 3 immediately preceding, we can call it as EP, immediately preceding previous year. So 3 immediately preceding previous year. So if you are actually in previous year 21-22, you are talking about previous year 20-21, previous year 19-20, previous year 18-19. If in all these 3 years, if you have had a gross receipts more than 1.5 lakhs, you'll have to maintain books of accounts as specified under this particular slide. Cash book, journal, your carbon copies and original copies. If you're a medical profession, the daily case registry and all those things has to be maintained. If in all 3 immediately preceding previous year, your gross receipts is more than 1.5 lakhs. If you're a newly set up business, if in that year, if it is more than 1.5 lakhs, you'll have to maintain the detailed books of account. So that's what it is about for profession. What about others? So what should others do? Other than profession, what should they maintain? If they're an individual HUF, if their income is more than 2.5 lakhs, income from business is more than 2.5 lakhs, or your sales, that is your turnover is more than 25 lakhs in any one of the 3 previous years, then you have to maintain. If you're any other associate other than the individual, it is much lower limit. 1.2 lakhs as far as your income from business is concerned, more than 1.2 lakhs. And if it is relating to turnover, it is more than 10 lakhs in any one of the 3 immediately preceding previous year. 1 year, one of the 3 years. In profession, we said in all the 3 years, in all 3 immediately preceding previous year, if your gross receipts are more than 1.5 lakhs. But here in other than profession, we are saying sales or turnover where gross receipts is more than 25 lakhs, or in other associate is more than 10 lakhs in all 3 immediately preceding previous year. In all the 3 immediately preceding previous year. So that's what you're actually calling it as for other associates. And if it's relating to a new business, if you think in that year it will exceed, you will have to maintain. So if you assume in this particular year, in the year in which you have actually started your business, If you think it will exceed 25 lakhs or 10 lakhs, you will have to maintain your books of account. Now, this is what it is about, right? So typically for an individual HUF, it is more than 2.5 lakhs. That is nothing but the basic exemption limit. What is the income tax basic exemption limit? Till which your income is not taxable, till 2.5 lakhs. So that's the limit specified here. So this 2.5 lakhs is nothing but the basic exemption limit for income tax. So that's what you're actually calling it. For other assessees, it is 1.2 lakhs. Because for other than individual HUF, there is no slab rate, right? It is taxable from rupee 1 itself. So that's why you're calling it as 1.2 lakhs here for that. So that's how you actually remember. Other sections, 44AE, BB, BBB. So 44AE will keep this away because it is relating to non-residents. It is not applicable for your intermediate. So we'll keep 44AE alone. 44AE is for vehicles. Let's say goods vehicle, that is once used for logistics. So there is a minimum limit in which we'll have to maintain this business. We'll see that in the subsequent slide. If you have a lower limit, so if you have a lower income than what is prescribed under 44AE, you will have to maintain your books of account. Similarly, in 44AD, 44AD is for general business. If you have become ineligible, you are ineligible for 5 consecutive assessment years. So for that 5 assessment years, you'll have to maintain books of account if your income exceeds basic exemption limit. So what is basic exemption limit? 2.5 lakhs for a normal individual. So that is what it's about. So ineligible to claim the benefit of 44AD for 5 years. So in that period, you'll have to maintain books of account if your income is exceeding the basic exemption limit. So that's what 44AD is about. So this is for other business. So for profession, it specifically tells what books to maintain. For medical practitioner, what to maintain, where to maintain, how long to maintain. And it also says that it has to be maintained if your gross receipt is more than 1.5 lakhs in all 3 immediately preceding previous year. But whereas in business, it says if your sales turnover or gross receipts exceed 25 lakhs in any one of the 3 immediately preceding previous year. Whereas other assessees, instead of 25, it becomes 10. So that's what it is about. And 44AE, there is goods carriage business, lower income. 44AD, for ineligible persons under 44AD, they'll have to maintain books of account if their income is more than basic exemption limit. So we'll take this illustration 15. What does it say? It says, we know this is a person carrying on profession as a film artist. So he's an, let's assume he's an actor. His gross receipts more than 1.5 lakhs. More than 1.5, more than 1.5, this is less than 1.5. So since one of the 3 immediately preceding previous year is less than 1.5 lakhs, he need not maintain books of accounts. Now, when you're talking about no need to maintain books of accounts, the provision actually says maintain minimum records to support an assessing officer compute income. So even if you are actually not, even if you have not less than this limit, you'll have to maintain. So even if this provision is not applicable, you'll have to maintain minimum records to support officer to compute income. So to help the assessing officer compute total income for that particular assessee, you'll have to maintain minimum records. So when you say no need to maintain books of accounts, you'll have to maintain minimum records. Nothing is specified what is minimum or something. Whatever is required to help the assessing officer to maintain, to compute income, that must be maintained. So that's what it is about. So that's what is his obligation regarding maintenance of books of account? He has to maintain minimum records to support the assessing officer to compute total income of the assessee, of Vinod in this particular case. So that's what it is about. So we'll take a small break and then come back and discuss about other provisions. In the meantime, I'll see. Bharat, in real life, if the case 5 repeats of matching with the stamp duty value, then it will be a loss, right, sir? See, it is not actually a loss. See, government says you could have your own reasons why you are registering less than stamp duty value. There could be actual real reasons why you are registering less than the stamp duty value. Anything less than the stamp duty value is a loss only. Whatever we are talking about as full value consideration is only for income tax purposes. Your book accounts will not change. Your book accounts, your income is going to be only whatever we discussed earlier, whatever you actually received. There you don't do 110%, 120%. Only for income tax purposes, you are not changing. So loss or gain, actual loss or gain is based on books of account. Income tax is only purpose of computing a taxable scenario. So we cannot actually call it as loss thing. Mansha, relation between 43CA and 50C, as I told you, capital gain as 50C where you have the similar provision. But let me not talk about 50C here because it will be discussed in the capital gain chapter. For your understanding, it is exactly same. It is exactly same between 43C and 50C. Here you are talking about from recipient point of view, from the business angle. There you are talking from a capital asset. So 43CA is for stock in trade, 50C is for capital asset. That's the only probable difference between 43CA and 50C. Hitesh Jain, CMA comes under which category? What is CMA? Can you please tell me what CMA is? Probably I'll answer it. Bharat, what is the difference between 25 and 50 under books of account? No difference. Whatever we are talking about is maintaining copy or original. You will have to maintain what all you have to maintain as books of account. So if it is more than 25, you'll have to at least maintain a copy. If it crosses 50, you'll have to maintain the original bill itself. Whatever original bill you'll have to maintain. Mansha, yeah. So notified profession can be teaching profession because in some other law it says you'll have to maintain books of account. In 44AA, in notified profession, it has not been specified at teaching. But if some other law says you'll have to maintain books of account, for example, companies. Company says every company has to maintain books of account. So the option of maintaining or not maintaining books of account is not applicable for companies, correct? So if some other law or some other act tells you to maintain books of account, you will have to, of course, maintain. Oh, you want to know whether cost and management accountant is a specified profession. It has actually not been listed, but maybe they still fall under the word accountant. Since there is a specific word called accountancy, CMA will fall under accountancy profession. So that's what it is. So, okay, we'll take a short break, probably a 10-minute break, and then we'll come back. So see you after the break in 10 minutes. Thank you. So welcome back after a short break. Hope you all had a short relaxation of what all provisions we had actually been seeing. So many things to remember and so many different provisions. So as I told you, the intention of all the provisions is only to make sure that nothing skips, is very clear to the point, and income is computed in accordance to the law. So that's the pure intention. And of course, as chartered accountant, when we keep reading this or when we keep linking provision, it'll become so easy that you'll start telling the sections and the provisions out of your own memory. So it'll come from heart, not even from your somewhere. It will straight be loaded into your heart rather than your memory. So that's the importance when you're continuously reading it with interest and intention. So continuing further with the same intention, with the out of heart, whatever I've been teaching, whatever you have been understanding, with the same intention, let's move on to the last segment of business of profession. We have a few more slides to just understand what the rest of the business of profession. So we are going to cover about a section where we are going to talk about two areas. One is, when is audit of accounts mandatory under Income Tax Act? So we are talking about separate audit for Income Tax Act. Then we have a slide for presumptive taxation. We'll first understand about audit of accounts. We all know what audit is, right? Hopefully you will be studying in your intermediate also. Audit is typically auditing the books of accounts to certify that the financial statements are true and fair, right? So that's what, as an auditor, it is our duty to do that. This is from the angle of, let's say, Companies Act. So audit is being recommended by Companies Act. Now, income tax says, why you alone should recommend tax audit? Why should I also not recommend audit? So income tax says, you make sure that it is being audited under the accounting standards, all of that. So whatever audit you're referring, it is from accounting and standards angle or auditing standards angle. Now, I also have a law. I have Income Tax Act 1961. So I will refer chartered accountants to audit books of accounts from the angle of Income Tax Act. Why should there be audit only from the angle of Companies Act? Let me have an audit from the angle of Income Tax Act also. So this is what is like giving more work to chartered accountants, more business opportunities, more work. Now, but is this applicable to everyone? Is this applicable to everyone? So we said audit of account is basically saying that certain persons' books of accounts are supposed to be audited from the angle of Income Tax Act. So it will be basically an audit report in the form of 3CA or 3CB. Let's not get into what CA, CB and all is about. And there will be a detailed form called Form 3CD, where only you will have specific clauses to be audited, to be reported based on the audit observation. So that is your Form 3CD. Now, the applicability varies based on what you are actually doing. If you are a business person, it depends on your turnover or gross receipts. Turnover, gross receipts or sales. So what is the limit? So I'm going to classify as two classifications. One is called general, another is called digital. Okay. You will not be able to find this word digital in your study material because it's just a classification that I've brought for you to easily understand this. So now we are going to understand what digital is before getting into the limits. So what exactly digital is? In that previous year, if may aggregate cash receipts, which means non-digital, correct? Non-digital, non-banking. Aggregate cash receipts is less than or equal to 5% of total receipt, which means my cash transactions in income is not more than 5%. It's less than or equal to 5%. Then not just my cash receipts, also my cash payments. See the word and. So not just my cash receipts, also my cash payments. Aggregate cash payment is less than 5% of total payment. So if my income is 200, my cash payment should be less than or equal to 10. If my expenditure is, let's say 150, it should be less than or equal to 7.5. So that is 5%. Less than or equal to 5% of my cash receipts and cash payments. So that is what it is about. When you say total receipts, it includes all the receipts in the form of whatever you're receiving in your organization. When you say payments, whatever form of payments that you're talking about, expenditures, liability, whatever it is. So total receipt, total payment. So it should be less than 5%. The cash receipt should be less than or equal to 5%. It cannot exceed 5%. So now, if you are a business, see, this digital limit is only for business people. So if you are a business people, if your sales turnover gross receipts, and if you satisfy the conditions specified in digital transactions, then your limit is 10 crore. Only when your turnover or gross receipt or sales exceeds 10 crore, audit is mandatory. Audit is mandatory. Whereas for other transactions, that is for general business, that is, let's say your cash receipt is more than 5%, your cash payment is more than 5%, then it is 1 crore. The limit is 1 crore. The limit is 1 crore if you are a general person. If you are specifically satisfying the digital condition, then your limit becomes 10 crore. 1 becomes 10. So 1 becomes 10 in respect to business. In profession, nothing is relevant. No digital, no general. I am least bothered how you are doing transaction. But if your gross receipts exceed 50 lakhs, you do. So I don't have any extra benefit for profession people like us. So there is no extra benefit given to profession people like us. So as they say, when your gross receipt crosses 50 lakhs itself, so you don't wait till 1 crore, 10 crore and all. You are chartered accountant. You have bigger brains. So let the receipts be 50 lakhs. So if you are dealing with profession, the limit is 50 lakhs. Once it crosses 50 lakhs, it has to be audited. The books of accounts, the accounts has to be audited separately. And there are other 3 categories. That is your presumptive business. That is your specified businesses, 44 AE, AD, ADA. In AE and ADA, you will have to do a separate audit if you are booking profits lower than the limits prescribed under that provision. Whatever has been prescribed under 44 AE, if you have lower profits, it has to be done. Similarly, if you have 44 ADA, lower profit. What is 44 AE, ADA, AD? Next slide, I'll explain you. For now, just remember the letters 44 AE, AD, and ADA. So AD, if you actually have ineligible, that is, if you are ineligible to claim benefits under 44 AD for 5 years period and your income exceeds basic limit, you will have to do a tax audit. So this is what it is about. So for business, if you satisfy the digital condition, that is your aggregate cash receipts is less than 5, your cash receipts is less than 5% of your total receipts, less than or equal to, your aggregate cash payment is less than or equal to 5% of total payments. If that's satisfied, your turnover limit is, tax audit is required only if your turnover exceeds 10 crore. Whereas in general cases, it is applicable when your turnover exceeds 1 crore itself. Whereas profession, it is 50 lakhs. It's not 1 crore, it is 50 lakhs. And for 44 AE and ADA, if you book lower profits than what has been prescribed under the specific section. 44 AD, if you are ineligible for 5 years, that period, and if your income exceeds basic exemption limit, it is applicable. So this is 44 AB, that is audit. You call it as tax audit. So statutory audit is audit under your what you call Companies Act. Your internal audit is based on your auditing standards. Now you have tax audit, which is basically based on your income tax act. So these are different audits that we can talk about. There are several audits also. For income tax angle, it is tax audit. So that's what it is about, right? So tax audit is what we have discussed about the limit in business, profession, and presumptive businesses. Now, as I've been using this sections 44 AE, AD, ADA, it is important to understand what these sections or what is presumptive taxation all about. So we'll move on to understand what presumptive taxation is all about. Okay, so we'll start with presumptive taxation. So what is presumptive taxation? Presumptive taxation is based on, oops, I've written it somewhere. Sorry. Presumptive taxation is something like estimation. So you're presuming that your income should be only this much, because I'm actually not maintaining books of accounts. Please understand, Actually, I'm not maintaining books of accounts. So I'm presuming my income could have been this much. So that becomes my income. Now, can I give this benefit to everyone? I can't, right? Because we said if you're a company and the company said it is mandatory that you'll have to maintain books of account. So where does the adoption comes for not maintaining books of account? Similarly, if you're an LLP, that is a limited liability partnership, you're supposed to maintain uh, you're supposed to maintain your books of accounts. So it automatically becomes mandatory to maintain books of accounts. So now we are talking about situation where you need not maintain books of account. Remember in 44AA, we saw what is the requirement to maintain books of account. Correct. Now we are saying you need not maintain books of account even if your limits are beyond what has been specified under 44AA, the 1.5 lakhs for profession or your 25 lakhs or 10 lakhs for turnover in case of your other businesses. So now, even if that surpasses, even if that exceeds that limit, whatever you're saying, you need not maintain books of account. Under what conditions? So now 44AD is for business. 44AD is for profession. 44AE is for logistics. Logistics business. Okay, so that's what it is about. Now we are going to understand each of the section in a tabular format. I'm linking all the three sections for you to easily understand how this section works. The first thing that we are going to understand is who are all the eligible assessee. So who can claim this benefit? Who are allowed to claim benefit under section 44 AD or ADA or AE? For AD, the provision says it can be claimed by resident individual, HUF or firm. Resident individual, HUF or firm, and it is not applicable for LLP or a tax holiday unit. So when you say tax holiday unit, there are some business on which there is 100% tax exemption. 100% tax exemption. So such business must be audited. Such business must be audited. Books of account should be maintained. So it is not applicable for such people who are maintaining your books of accounts, who are claiming 100% as tax holiday. So that's what it is about. So now, what you mean by this? Next thing, 44 ADA. So please, I'll just make a correction here. The same applies here also. The same applies here. So for 44 AD also, it is only for resident individuals or partnership firm. It does not include LLP. So this applies here also. I'm sorry for the confusion. The only thing is your ADA will not have HUF. Probably I'll rephrase it. I'll just write it separately. This alone here separately. So 44 AD is for resident, individual, HUF, firm. Okay. 44 ADA is for resident, individual, firm. So HUF doesn't run professional businesses, so that doesn't come under the category. Professional things doesn't come under a family business. So it's not possible. That's why HUF is not there. So it is individual or firm. So that's what the eligible assessee is about. And both cases, no LLP. Both cases, no LLP. So that's what it is about. So I'll just correct this and probably upload it subsequently. So for 44 AD, it is a resident individual HUF fund firm, not LLPs. For 44 ADA, it is resident individuals or partnership firm and not LLP. So that's what it is about. Next thing we are going to understand is what is eligible business. So what business can they operate? So what business can they operate? So as far as their business goes, their business. So when you talk about business, 44 AD, for 44 AD, you can have any business other than some specific businesses. So other than some specific businesses, I think the screen is stuck. Just give me a second. And there was a screen got stuck, so I've just corrected it. I'll continue. Yeah. So sorry for the screen stuck issue. So I'll just continue. So who are the eligible businesses? So as far as the eligible businesses goes, for 44AD, it includes every business, but not for business covered under 44AE because there's a separate section. So it is not included. And then you have any agency businesses, any agency business who are just doing principal agency relationship. That is basically trading businesses, correct? So agency businesses could be in the nature of trading. So that is not covered. Income under commission or brokerage. Income under commission or brokerage is not also allowed. So these two businesses, that is any agency business or commission or brokerage is not allowed. Apart from that, 44AE business is also not covered. Why? Because it has a separate section by itself. That's why it is not covered in 44AD. So that's what the eligible business is about. But when it comes to 44ADA, any profession specified under section 44AA. So legal, medical, accountancy, technical consultancy, interior decorator, architecture or engineer, your then notified profession, film artist, your company secretary. So all these professions are covered under profession category. So profession under section 44AA includes all of these. So that's what profession is all about. And then you have for 44AE, you are specifically talking about only one business. What business is it? It is about plying, hiring, leasing of goods carriages who owns not more than 10 vehicles at any time during the previous year. So not even in one single month, you should have more than 10 vehicles. So maximum vehicle you can own in the entire year is only 10. Take any day, any month, any period, it should be not more than 10. So the maximum is only 10. So that's what it is about. So these are the eligible business under 3 sections. And then you have turnover limit. What do you mean by turnover limit? You have turnover limit for each of this section. So for 44 AD, it is up to 2 crores. So up to 2 crores only you can opt for this 44 AD. If it crosses beyond 2 crores, you cannot opt for this. And then you have 44 ADA where up to 50 lakhs only you can choose this. Otherwise, you cannot choose this presumptive basis. And then for 44 AE, there is no limit because the limit itself is only the vehicle count, 10 vehicles. So that's the limit specified. So that's about it. Other provisions of 44 AD. Once you have an eligible business, eligible assessee, eligible business within the prescribed limit, that is your 2 crore for 44 AD, 50 lakhs for 44 ADA, you can opt to this section. Now, once you opt this section, what will be your income? What will be your income? So that's what we are going to understand now. If your income is less than, if your turnover is less than 2 crores in 44 AD, you opt 44 AD, your income, taxable income will be 8% of turnover or gross receipts. But to the extent you have received in digital mode, that is through account pay, check or through banking mode, the limit goes to 6%. So to the extent, let's say out of 100, 80 through bank, 20 through cash. For this 80, you can opt 6%. For this 20, you can opt 8%. So that's what it is. For 6%, where you have received it digitally, 8% in other cases. So this is the limit. So that's what it is about. Now, for 44 ADA, straight away, whatever your gross receipts, half of it, that is 50% of it, is considered as thing. For 44 AE, we said 10 vehicles. The vehicles is categorized as two categories. One is heavy goods vehicle, all other vehicle. When you say heavy goods vehicle, the total weight of the vehicle is greater than 12,000 kgs. If it is greater than 12,000 kgs, then that vehicle becomes heavy goods vehicle. If it is a heavy goods vehicle, the income is on the ton basis. So it is 1,000 per ton of gross vehicle weight or unladen weight for every month. When you say month, it includes part of the month. Even if I own the vehicle for 2 days, that also gets included. So it includes part of the month. So per ton, 1,000 per kg. But whereas for other vehicles, that is other than heavy goods vehicle, it is flat rate. That is 7,500 per month, including part of the month. in which the assessee was owning that vehicle. So that's what. If you have been owning that vehicle for 6 months, for 6 months into 7,500 becomes my income. For heavy goods vehicle, it is 1,000 per ton of the gross vehicle weight. So that's what it is about. And whether books of account needs to be maintained, we told you since it is presumptive basis, books of account need not be maintained. So it is an exception to section 44AA. What about expenses? Can you claim expenses on this? Any expenses under section 30 to 38, that is your repair, rent, your scientific research, or your depreciation, or your what you call your other deductions, general deductions, everything is assumed to be already considered. So this 8% is nothing but imagining that everything has been provided. So nothing else needs to be provided. If it is a firm, remuneration is also already considered to be provided. So nothing needs to be provided additionally for 40B. But in 44AE alone, apart from whatever you are considering, apart from whatever you are treating as the 7,500 or 1,000 per vehicle, you can consider additionally the remuneration. So that's the difference. 44AD and ADA does not allow remuneration also. 44AE allows remuneration. And you are not allowing depreciation, correct? You are not allowing depreciation. So how will you know the return on value of each of the assets? Return on value shall be considered as if you are providing depreciation under section 32. Though you don't maintain books of accounts, you calculate depreciation as if you are maintaining books of accounts. So that's what it is about. So return on value shall be calculated as if the depreciation under section 32 is being provided for each year. So that's what a WDV is about. What about advance tax? Should you pay advance tax? Advance tax is typically paid 4 quarters, 4 times in a year. So for 44 AD and ADA, advance tax is only once in a year. So for every financial year, you pay advance tax on or before 15th March of that particular previous year. Whereas for 44 AE, regular, there is no change. Whatever is the regular due dates for advance tax, that is applicable. What are the due dates? What are the provisions for advance tax? My answer is, hope you all know, it's a separate chapter. So you will come to know about that in that particular chapter. So you must limit your knowledge to advance tax is regular advance tax for 44 AE. It is once in a year for 44 AD and 44 ADA. So that's what you're actually calling it as 15th March of the previous year. So that's all about it. So probably we'll understand this through a exercise problem. So Mr. Praveen is engaged in a retail trade. Is a retail trade. Reports a turnover of 1.98 crores, right? So he's reporting a turnover of 1.98 crores. So what is he saying? And it says that his books of account is his profit, that is his income in the books of account. So he's being maintaining some books of account, 13.2 lakhs is what has been computed. Retail trade is the only source of income. For first year, he has declared business income according to the okay, in assessment year 21-22, he has declared his income under the 44 AD. So it wants us to understand, is Mr. Praveen also eligible to opt for presumptive determination for 22-23? If so, determine what will be his income. In case Praveen does not opt, what becomes the situation? So these are the questions that we need to answer. So first of all, whether Praveen is eligible thing, since this limit is below 200 lakhs, he is eligible to opt business presumptive taxation. It says retail trade. It doesn't use the word agency. So only when the word agency comes, it is not allowed. So when it specifically uses the word retail trade, it is still allowed. So what is it? Since it is less than 2 crores, he is eligible to use presumptive taxation under section 44 AD. He can opt. So what will be his income? So for this, he can opt. So for this, what will be his income? It will be 1,98,50 lakhs into, does it say about anything about the cash collection, digital collection? It doesn't talk about any collection or something. So we'll apply 8%. So 1,98 lakh 50,000 into 8%. That is your 15 lakh 88,000. So 15 lakh 88,000 will be your income under section 44 AD. The next question is, In case of Mr. Praveen, does not opt for presumptive taxation. If he has not opted for presumptive taxation in AY 22-23, AY 22-23, if he has not opted, what happens is he will not be eligible for 5 consecutive years. So let's take 22-23, 24, 25, 26, 27. So till AY 26-27, he cannot opt presumptive taxation. So for 5 consecutive years from the relevant assessment year. So from 23, 24, 25, 23, 24, 25, 26, 27. So for 5 continuous years, he is not able to claim it for thing. And in fact, it will be till 27, 28. Because it is 5 years after the current assessment year. So current relevant assessment year is 22-23. So we'll have to add 5 years. So 5 consecutive assessment year will become that 22-23. That is 5 years after that. So it will be 23-24, 25-26 till 27-28. So that will be the period for which you'll not be able to claim the 44AD. So you'll be ineligible to claim 44AD for this 5 years. So that's what the section is about, right? Correct? Okay, so we'll move on to the next thing. Illustration 17. So where we say vehicle 44AE. So totally how many vehicles he is owning? 2 plus 1 plus 3 plus 1 plus 2 plus 1. So 3, 6, 7, 9, 10. So across the year, everything is within the previous year, 21-22. So in this previous year, 21-22, he is actually owning 10 vehicles, not more than 10. So he is eligible. Now we'll have to split between heavy goods vehicle and other than heavy goods vehicle. So these both are heavy goods vehicle. So these both are heavy goods vehicle. Rest of them are not heavy goods vehicle. So let's take first thing on 29-8-21. So it is 1000 per ton, correct? So per ton. So it is totally 15,000 kgs. So the question says totally 15,000 kgs. So it is 15 tons. So 15 into 1000, correct? So it is 15,000. So 15,000 per vehicle. 15,000 per vehicle. It is maintained from August. Even if it is 29th August, it has to be considered for 1 month. So August, September, October, November, December, January, February, March. 8 months. Correct? It is 1000 per ton. So we'll have to compute how much? We'll have to compute 15,000 into 8. So typically, whatever he has been owning, that is, he has been owning it for 8 months. Correct? He has been owning for 8 months. How many vehicles? 2 vehicles. So number of months it's vehicles. So it is basically 18. 8 into 2. So you'll be eligible for 2 vehicles, 8 months, 15,000. That is 1000 per ton. So that's what you'll have to calculate. So for that, it will be this much, correct? So this is one thing. Second vehicle, 23rd February 2022. Here also it is 15,000. 15,000. It is months is February and March, 2 months into 1 vehicle only. So it is 1 vehicle only. So that becomes the next vehicle, correct? So what will this be there? So this will typically be 15,000 into 8 into 2. So this will be 2,40,000. And then it will be into 2 months. So that is 30,000. So for heavy goods vehicle, it will be 2,70,000. So for heavy goods vehicle, it will be 2,70,000. Next is, it will be how much? For other goods vehicle. So for other goods vehicle, we can actually calculate the total number of months alone. So for ones purchased on 10th April 21, because it is flat, right? 7,500 per month. So we need to understand how many months. So for 10/4/2021, it is across the year. So throughout the year. So it is 2 into 12, 24 months. For ones on 15th March 2022, it is 1 month. Correct? So it is 1 vehicle into 1 month. So it is 1. and then 16th July 21. So July, August, September, October, November, December, January, February, March, 9 months. So 3 vehicles, 3 into 9, 27, correct? And then 6th vehicle is 2nd January 2022. How many vehicles? 1 vehicle from January. So 1 into 3 months. So 3. So that's what it is there. So 25, 52, 55 months. So it is 55 months. For 55 months, you are having 7,500 per month. So 55 into 7,500. So what will be the amount? 55 into 7,500. So it will be 4,12,500. So in total, it will be, here you have 2,70,000. So it will become 6,82,500. So that will be a total thing. Total thing for this particular vehicle thing. So that's what it is about, right? So that's all about your business or profession. So I have just one slide alone extra. I guess it have already been covered. It would have been independently covered in your exempt income. I think this should have already been covered. I'm not sure whether it is covered or not. In case if it is already covered, we leave it. Otherwise, just see this table alone. Depending upon the business, there is a segregation between business and agriculture income. Hitesh, audit is an independent examination of the financial statement. Yeah, audit is definitely an independent examination. That is with respect to whatever your Companies Act or whatever audit procedure you are seeing. Here, this income tax, this tax audit is also an independent examination only, but from the angle of Income Tax Act. Raghavan, can CA audit his own business or profession? No. Of course, you will see that in your, what you call, when you talk about this Companies Act and all, who can audit? Basically, a relative cannot audit. Relative or the same person cannot audit the business. Because when you say audit, you need a third party's eye. Third person's eye must, third party's view. So you cannot have a same, you cannot audit your own business or profession. Mancha, what is the difference between section 44AA1 and section 44AB for profession? Both profession deals with books of account for profession. Mancha, 44AA subsection 1 tells you when should you maintain books of account. It tells you if you are having 1.5 lakhs more than gross receipts in the 3 immediately preceding previous year, you should maintain books of account. What books of account? Cash book, journal, your copies of bill, original bills, correct? And if you're a medical practitioner, that case registry and inventory of drugs and other things. So this is covered in 44A. 44AB is not about maintenance of books of account. 44AB is about auditing books of account. That is a separate audit for certain assessees. For profession, what does it say? It says if you have earned more than 50 lakhs of gross receipts in that particular previous year, tax audit is mandatory. So a chartered accountant has to audit a professional business if the gross receipts has exceeded 50 lakhs, irrespective of whether the books have already been audited or not. So that's what it is about, correct? Prabhas, specified date for tax audit is 30th September, but the final accounts are closed on 31st March. See, on 31st March, you close your books of account. Due date of filing return of income for people who are subject to tax audit is actually 31st October. It's actually 31st October. I'll just give you a brief date. So, audit close, I'll call it as accounts close. Accounts close is 31st March. Okay. Tax audit. If you're having tax audit, the due date is 30th September. Return filing. Return filing is 31st October. For regular people, the dates changes. There are other dates also, but typically this is a mostly common date. So account closes on 31st March, but your tax audit closes on 30th September and your return closes on 31st October. The period for all these, the period is same, financial year 21-22. The one previous year. Just that you do extra audit. 31st March, you close your accounts. Then you do your statutory audit. then you do tax audit, then you do return filing of income. Only that changes. Otherwise, the process is same. There is nothing to do with future income here, because whatever you are closing on 31st March is only audited for 30th September and 31st October and all. So whatever is for the period previous year 21-22 only is audited, irrespective of the date you are auditing. And when you are going through your audit chapter and all, there will be where the certain standards tell you that whatever has happened between 31st March and before the signing date, there are specific treatments. So that's a different topic. As far as this income tax goes, account closes on 31st March. For that period, previous year 21-22, you do the audit before 30th September 2022. Archie Gupta, which business are tax holidays? Tax holidays are not agriculture business. Tax holiday is something about a business where it says the entire profit from the business is tax exempt. You have section 10AA, in certain sections in 10A and all, 10A and all. So there it is exempt, the business is exempt. Then you also have various business like ATIA, IB and all. That is all your final chapter. So all this will be discussed in your final. So tax holiday is basically where the entire business is tax exempt. So such units cannot opt 44AD. So that's what it is about. What about the huge shops, Puja, Saravana stores, GRT, all those things? They are not companies. They are companies. So it will be in the name of private limited only. So that is how they will be handling the business. So though the trade name is Saravana stores or GRT, behind that there will be a private limited or a public limited company. So only then they are thing. So in case if there is a business with sole proprietor or partnership firm, yes, of course, if they want, they can opt this 44AD and all. Archie Gupta, whether 44AD, ADA contains OPC? Never. Because company includes one-person company. Once you fall as a company, you need to maintain books of accounts. So one-person company also does not come. Pooja, do hired vehicles fall under own limit? No. It must be owned by the assessee, in the own name of the assessee. So only then it is basically applicable. Karthik, under tax holiday, if it is 100% tax free, why should it maintain accounts and get audited? Someone has to tell you that you have maintained the books properly. You cannot come and tell my income is 10 crores. 10 crore also I will not pay tax. So there might be a situation where you have wrongly reported income. Just converting, you're just reporting some rough number. So someone has to audit your books of accounts and tell you that this is the income that is eligible for a tax holiday. So it becomes very important to certify that this is the income that is eligible for a tax holiday. That's why we are saying persons who are subject to tax holiday must necessarily maintain books of accounts and gets it audited. Pradeep, what will be the limit for income under commission? No limit, because once you receive commission or brokerage, the business is not eligible for 44AD. So you cannot claim 44AD if your business is commission or brokerage. Mansha, after 5-year period, that is ineligible period, if he wants, he can opt for presumptive taxation. He can again opt for 44AD. So he is free to opt 44AD after the 5 years. That is in the 6th year, he can again opt for 44AD. Rafiq Bhai, last example. What was the last example? See, I'm taking each vehicle and multiplying it the number of months. If the question is related to illustration 7, I'm considering each vehicle. For April, I've used it for 12 months. This I've used it for 1 month. This from July to March. So I'm taking month. I'm taking months. I'm taking the number of months that I've used. This is number of vehicles. This is number of vehicles. So I'm multiplying it by the number of vehicles and then using it. So that's what the example is. The question is related to that particular example. That's how I have worked out. Presumptive tax. Abhinay, in presumptive tax, they gave option to claim higher sum. Can that sum be changed year after year? In 44 AD or AE or ADA, whatever it is, you can choose to opt higher income. So you can choose to opt higher income. If you want, you can keep it annual. So whatever we are talking about, this 8%, 6% is the minimum limit. But please, let's not discuss about it because it's not at all relevant for your examination. It is purely practical scenario. After you become chartered accountant, you will know the nuances in that 8, 6, and 50 and all. For intermediate examination, please remember it is 8%, it is 6%, it is 7,500 per month or 1,000 per ton. Don't deviate from this numbers. Don't deviate from this number. Mohammed Taufik, cash receipts payment includes cash withdrawal from no. Cash receipts or payment does not include cash withdrawal. Whatever you are receiving in the form of income, whatever you are paying in the form of expenditure or liability. Raghavan, how can one maintain books of account if he is working as a profession? How will you work as a profession? When you say profession, it is your own business. You are running a profession. You are doing a business. You don't earn salary. So you earn income from profession. So whatever income you are earning from profession, if it crosses 1.5 lakhs in the last 3 years, you'll have to maintain books of accounts. Madhuri, the 50 lakhs into 50% is your income. So if you're earning 40 lakhs, let's say you're earning 40 lakhs into 50% is 20 lakhs. On this, you compute tax. So whatever is the tax should be calculated from this 20 lakhs. So this is not the tax. This is income. Sandhya, one more class on Monday? Yes, of course. It will be purely problem solving. So it will be fully problem solving, exam oriented approach to business, and also some of the salaries also will be included. Pooja, if a person opts for presumptive tax and his income is greater than present income, she'll be allowed to pay tax only on presumptive income. That's what I'm saying. That is a very practical question. So technically, see, I'll tell you, in fact, if you want, I'll just write it here. 44 AD, 44 ADA. Okay. Here, it is not higher income and all. It doesn't bother. Doesn't matter how much you earn. What is taxable is 8%, 6%, or 50%, as the case may be. In 44 AE, the word is 7,500 per month, 1,000 per ton. Okay. This or actual income, whichever is higher. So this word is specified in 44 AE. So as far as 44 AE alone, if you actually have higher income, you'll have to use that. Otherwise, you'll have to use that. Now, coming back to my statement, for your examination, please ignore this. For your examination, please ignore this how many ever times you want. What you have to remember is only this for your examination. Please don't go beyond that. It is always good to know everything. There is nothing wrong in knowing the entire taxation, entire book, or nothing wrong like that. But your primary objective is to focus on the examination. So understand from the examination point of view, and then later point in time, probably you can understand in a general point of view also. So for time being, just stop your understanding with this and this. Don't go into this. So don't go into whether, what if you are actually earning higher and all. Don't go into that. Mansha, 44 AB limit is 50 lakh and 44 ADA limit is 50 lakh. My question is, does this 44AD optional for profession? For example, newly turnover is 40 lakhs, is required to apply section 44AD or 44AA to sufficient? See, for your question, Mansha, up to 50 lakhs, what is applicable? What may be applied is 44 ADA. If applied, if this is applied, 44 AA does not apply. Okay, this is up to 50 lakhs. Now let's above 50 lakhs. Above 50 lakhs, what applies is 44 AB and 44 AA. 44 AB and 44 AA. Because you have earned above 50 lakhs. Somesh, will be some harder question will be taken lecture. Yes, I have some problems based on your whatever exam oriented problems. So of course, we'll solve that in the subsequent thing. Profession of teaching. Teaching is not a profession. Teaching is not a profession according to the professions thing. Only thing it uses is technical consultancy, accountancy and all. So technically, teaching is not a profession according to Income Tax Act. Okay, Kaveri, I guess you already asked this question. I'm sorry I missed it before the break. So typically for that 43CA residential unit, the actual period stated in the Act is 12th November 2022, 30th June 21, correct? So this is the date period provided. If the transfer has happened between this period, 43CA is applies in the respect to 120% instead of 110%. Now, my point was, since it is some random date, I told you in your examination, since your exam period is previous year 2021-22. So the relevant 43CA will be 1st April 21 to 30th June 2021. I just gave this as a comfort. So you may not actually remember the random date. Whatever has happened between 1st April 2021 and 30th June 2021 is only the relevant period for your examination, So that's what I was telling. Archie, please tell what you write here with 7,500 and something in notes. What you write here with 7,500 and something in notes. I don't actually understand that. See if it is okay. You want to know what the 7,000 for 44 AE? I'm just telling you it is 7,500 per month per vehicle. 1,000 per ton per month per thing. So that's what I was just telling. If it is relating to 7,500. Okay, that's all about the provisions. Now what we'll do is we will. Okay, there's this agriculture question. So if it's basically rubber plant grown. What is the actual procedure? So for rubber plant, 35 is business. So business is 35%. So that's what rubber is about. So from 3 lakh, 35% is business income, 65% is agricultural income. Sale of coffee grown and cured in air card. So whatever has happened in air card, 25% is business, 75% is agriculture. So out of 1 lakh, 25,000 will be taxable. Sale coffee bean code in Colombo. So it is not available. So it is 100% business. 100% business because it's outside India. Income from tea grown and manufactured in Simla, 4 lakhs. So for tea, it is 40% business. So out of 4 lakhs, you take 40,000 only. Sapling, seedling, grown in thing. This is, you would have studied that in exemption chapter. 100% is agriculture. So 0% business. So this is completely exempt. So that is how you differentiate between business income and agriculture income, where a business is partly business and partly agriculture. Okay, I'll just solve this question alone for you to. This is exercise number 1 in study material, just to give a hands-on depreciation alone. So typically, the depreciation question says, engage in manufacture of pesticide furnishes a thing. So they are into manufacture. This is important. Why? As I told you, when you're reading the question, see what is important. Sometimes certain words are important for your solution. Certain words are confusing for your solution. Certain words are not at all relevant for your solution. So you'll have to categorize the word and understand the question. So when you're reading the question, Venus engaged in manufacture. We need to see whether the word manufacture is relevant or not. Why is manufacturing relevant? Because the provision changes. If it is a depreciation question, whether additional depreciation should be given, should not be given, depends on whether you are manufacturing something. So now it says manufacturing. So you are eligible for additional depreciation. Now the WDV of plant and machinery on March 21 is 30. Previous year's 2021 is 4.75. So your actual opening WDV will be 30 minus 4.75. New machinery in September 21, new machinery in 2021, September 21, new machinery in December 2021, computers purchased in January 2022. Now, what are the additional information? All assets are paid by account pay check. What section? Why is this relevant? Account pay check. How is this relevant? There is a section. What section we studied? 40A3, which says if it is more than 10,000, that should not be considered. So now everything is account pay check, so nothing needs to be ignored. Assets were put to use immediately. So the date of purchase is only date of put to use. Now new machinery on 1st December and computer have been installed in office. Keyword, relevant word, not relevant word. It is a relevant word. Why? Additional depreciation is not allowed. Additional depreciation is not allowed if you have used the asset in office. So whatever asset has been installed in office premises, no additional depreciation. Whatever is being used only for manufacturing purposes is only eligible for additional depreciation. During the year end, a new machinery had been purchased on 31st October 2020, that is previous year. Additional depreciation has been claimed thereon. Now we need to see whether this is relevant or not relevant. Why? For additional depreciation, in the previous year, if the asset was put to use for less than 180 days, the additional depreciation would have been given only for 50% of whatever it is. So what is additional depreciation? 20%. What would have been actually provided in the books of accounts when the income tax purpose as additional depreciation? Only 10%. That is 50% into 20%. So 10% only would have been provided as additional depreciation in the earlier year. So in the current year, the balance 10% can be provided as additional depreciation. So that's why this is also important. Depreciation rate is being requested to be considered as 15%. Now they want us to understand this entire mechanism, what is actually happening. So it also says 115 BSE has not been opted. So we need not do anything else apart from that. So now how do we compute? We start with what? We start with the provision. So I'll start with exercise 1. Okay, exercise 1. So what are we actually doing? We need to compute depreciation for assessment year 22-23. So now what I write particulars. There are 2 category of assets, that is 2 rates, right? Computer is taxed at 40%. Your plant and machinery is taxed at 15%. So now we need to compute. correct? We'll also have a reference column. Wherever we need to write a notes or something, we'll have that also. Now, the first thing, what should we write? We should start with the regular depreciation, right? So regular depreciation. So for that, we need to understand what is the opening WDV. So opening WDV is required to know that how much depreciation needs to be calculated. Only on that we'll have to calculate the actual depreciation for the whole year. Now, then we'll have to do new assets. So now to know what is opening WDV, we can calculate through this. We'll have to calculate the opening WDV. So now what will be the opening WDV typically? I'll just write it below. So opening WDV, I need to identify. So how will I identify opening WDV? So opening WDV, closing WDV on 31st March 2021, correct? So that's what the closing on 31st March 2021 is, 30 lakhs less depreciation for financial year or previous year 2021. Previous year 2021. How much was it? 4.75. So 25.25 is the WDV, opening WDV for previous year 21-22, correct? So on this 25.75 only, I will be actually computing 15%. So what will be the 15% of 25.75? 25.75 into 15%. So I'll compute 3.25, right? 25 lakh 25,000. 25 into 15%. So that is 3.79. If you want, you can keep more decimals also. That's okay. But since you know everything is in lakhs, you can continue to do it in lakhs. It's up to you only. And then new assets. So what was purchased in the new asset? It was plant and machinery, right? So as far as this new asset, there was no opening asset for computer. There was only for plant and machinery. There was no opening asset for computer. Now the new asset, first thing was plant and machinery, right? Plant and machinery, what date? 1st September 2021. That is, you have purchased it on 1st September 2021, correct? So that's the first asset. So for 1st September 2021, what is the thing? What is your asset value? Your asset value is 10 lakhs. Your asset value is 10 lakhs. So 10 lakhs into 15%. So 10 lakh into 15% will be 1.5 lakhs. So computer nil. The second asset, plant and machinery, 1st December 2021. For this, it is eligible. We can write here as it is only eligible for 50%. It is only eligible for 50% because it is December 2021. So 8 lakhs. So 8 lakhs into 15% divided by 2. So it is eligible only for 0.6. 0.6. So that is your plant and machinery, second plant and machinery. You can write a note saying that since the asset was put to use less than 180 days, 50% of depreciation is allowed. Next is what? Computer. Computer was purchased when? It was purchased in January 2022, correct? 3rd January. So 3rd January 2022. Same note. It is less than 150%, less than 180 days. So 50% of depreciation is allowed. How much is it? 4 lakhs. So for 4 lakhs, you take 40%. So 4 into 40% divided by 2. So it will be how much? 0.8. So 0.80. Correct? 0.80. So now this is the total depreciation, whatever you have calculated. Now we need to know whether you have any additional depreciation. So we'll calculate this total depreciation. So how much is it? 5.29, 5.89, 5.89, 0.80. Now we'll have to calculate additional depreciation. additional depreciation. There are for two assets. First asset is whatever has been purchased this year. That is 1st September 21. So I can write a note 3 saying that what assets it is not eligible. I can say that additional depreciation is not eligible for the plant and machinery purchased in 1st December 2021 and computed because it is for office use, because it is installed in office premises. So that's what I can say. So other than that, the 1st September 2021, how much is asset? It's basically 10 lakhs, correct? 10 lakh is the asset value. Yeah, 10 lakhs. So on 10 lakhs, I'll have to calculate how much? 20%. So 10 lakh into 20%. It's for the whole year. So it is basically 2. And then second asset is basically what the old asset, that is previous year asset. So you can say previous year 2021 asset. I can write another note saying that the additional depreciation is provided for the balance 50% since the asset was a new plant and machinery eligible for additional depreciation in the previous year. So that's how you can write that also. So how much it will be? The asset value is actually how much? 10 lakhs. So that's also 10 lakhs. So out of 10 lakhs, what will be allowed is additional depreciation is 2 lakhs. 50% of that is 1 lakh. So the total depreciation will be 8.89 lakhs, 0.8. So it will be nothing but how much? 9.69 lakhs. So 9.69 lakhs will be the total depreciation eligible for this person who Mr. Venus. Mr. Venus will be eligible for 9%. So that's what it is about, correct? So with that, I guess we have this. Probably I'll have couple of questions. Another 10 minutes, I'll just rush through and try to finish it off. Construction of CSR building with CSR activities. CSR activity is not an eligible business under section 37, correct? CSR expenditure is not an eligible expenditure under section 37. So this 5.6 lakhs cannot be claimed as an eligible deduction under section 37. So it is not an eligible under section 37 because CSR expenses are not an eligible expenditure. Because it is considered to be not as wholly and exclusively for business purposes. Purchase of building for the purpose of specified business, setting up and operating warehouse facility of storage of food grain. So it is eligible under section 35 AD. The entire 100% of food grains, the machinery, the purchase of building is eligible for, only the land is not eligible. So 4.5 lakh is eligible under section 35 AD. Interest paid to Mr. X, a resident of 50,000 on which tax has not been deducted. So 30%. So 30% is disallowed under section 40A 1A. So how much is disallowed? 15,000 is disallowed. Balance 35,000 is allowed. So 15,000 is not allowed under section 40A, 40 clause A, subclause 1A, whereas 35,000 is allowed. 35,000 is allowed. 35,000 is allowed under section 36. 36 is the section where interest is allowed. So and then commodity transaction tax, 20,000 paid on sale of bullion. It is an allowed expenditure. So this is also allowed under section 37. Security transaction tax and commodity transaction tax is an eligible business expenditure. So this is how you answer it. So everything you write the provision. How do you write this? See, if each one of this has only 1 mark, you write in 1 or 2 lines. You basically write the provision or whatever you know. So keep it simple. Just probably 2-3 lines will be a sufficient answer if it is going to be a 1 mark. Just answers. Just saying, as per section 37, CSR expenditure is not an allowed expenditure as it is not considered to be wholly and exclusively for the business purpose. Hence, 5.6 lakhs will not be eligible for deduction under section, will not be eligible deduction under the head PGBP. So this is a basic line. So similarly, you write for everything. So each of the thing you write 1 or 2 lines, just explaining what the particular provision provides about. So that's what it is about. So I have just one more problem. examine the reasons for the following subdivisions, whether the following statements are true or false. So first thing is, for a dealer in shares and securities, security transaction tax, is it allowed? Is it allowed? Yes, right? So this is true. True, because yes, it is an allowed permissible business expenditure. Security transaction tax is a permissible business expenditure. Where a person follows mercantile system, he has accrued an expenditure of 25,000 and that has been, he has paid it through a crossed check. So it is not an account pay check, it is a crossed check with something like bearer check. So now 25,000 can be the profit and gains of business under section 40A 3A. Yes, previous year expenditure paid in current year through cash mode, that is non-banking mode, it becomes an disallowance under section 40A 3A. So it will be treated as a payment. So it will be treated as a disallowance under section 40A clause 3A. So this is also true. It is mandatory to provide depreciation under section 32 while computing. Yes, depreciation is not an option. It is mandatory. So there is no option to claim depreciation or not claim depreciation. It is mandatory. The mediclaim premium paid to GIC, General Insurance Corporation, by Mr. Lomesh for his employees by draft on deductible expenditure. Mediclaim for his employees. So we said insurance, two insurances are eligible. One is damage, destruction for stocks, another is employee. So these two insurance are eligible under section 36. So this is for the health of the employee. So this is also true because the insurance is for the health of the employee. So insurance for the health of employee, the premium paid on that is an eligible deduction under section 36. Under section 35 DDA, so that is VRS, right? Amortization of incurred under eligible voluntary retirement at the time of retirement can be done. So this basically what? It is not only at the time of retirement, it is done for the period of 5 years. So amortization is done for the period of 5 years. So it is not 1 year. It is not only at the time of retirement. It is done for the period of 5 years. Retirement year plus 4 years. So it is totally 5 years. So this is false. An existing associate engaged in trading activities can claim additional depreciation. The beginning itself, what does it say? It says trading concern. In respect of new plant, increase the value of such plant as compared to the approved. So moment it is trading, no additional depreciation. So this is also false because additional depreciation is eligible only for manufacturing units. Manufacturing units not eligible for trading units. So that's all about this particular question. So with that, I wind up today's session. I'll just answer some of the questions before I wind up. Rekha, please share my CA journey. Of course, if I have sufficient time, I'll be free to tell you. Maybe in the next class, I'll see if I can tell you. But every one of us who are wanted to become a chartered accountant, the one key factor here in becoming a chartered accountant is the belief. You believe every day, every morning when you wake up and when you see a mirror or something, you tell yourself that you're going to be a chartered accountant. So that confidence, that belief. Every day when you keep telling yourself you're going to be a chartered accountant and you're going to be a great chartered accountant, of course you will complete the exam at ease. So the belief, the confidence is what will make you clear. So that will be common for every CA journey. Everyone who has passed CA would have believed that they would have become a chartered accountant. So that's very critical and very important. How coaching seats are exempted? Oh, okay. See, the coaching seats, what we are talking about is basically relating to your sapling of seeds. So sapling of seeds is basically an agriculture income. So there, the concept of partly business, partly agriculture doesn't come. So sapling of seeds in nursery is basically an agriculture income. Mansha, so it means a professional have to apply section 44AD mandatory if income. No, 44 ADA, AD or AE are not mandatory. Presumptive taxation is optional. If you wanted to maintain books of account, you are free to maintain books of account. So that's not only when it crosses 50 lakhs, tax audit is mandatory. When your income crosses 50 lakhs, tax audit is mandatory. When your income is less than 50 lakhs, whether to maintain books of account or not is purely your choice. So it is not something which is mandatory. So 44 ADA or AD or AE, nothing is mandatory. If you have books of account, you are free to maintain and do your follow things. So hope I've answered that. So none of the business that you're talking about, 44 AD, AE or ADA, it is not mandatory. If your income is less than 50 lakhs, you may choose 44 ADA. But you cannot say this year I have maintained books of account, next year I have not maintained, again I am maintaining. You cannot do that. So you have to follow a uniform approach. Sandhya in 31/3/2021, WDV according to section 43 clause 6 does not include depreciation. So technically we'll have to reduce depreciation to arrive at the opening WDV. Closing WDV does not include depreciation. Minus depreciation will give you the next year's opening WDV. Pooja, we have evaluated answer sheets. What details do you expect? I have not evaluated the answer sheets of ICA. So typically, as I told you, one most important thing, probably an evaluator. If I have been an evaluator or I'm an evaluator, the first thing I'll try to understand is, I'll try to understand whether the student has understood the provision or answering or just somehow answering it. That's why I said in paper like income tax, notes are very critical. Notes makes most important thing because notes only makes the evaluator understand that you have understood the provision. So make sure you write the notes, you write the provisions very crisply and clearly. Somesh, it is difficult to remember depreciation rates in examination. See, the primary most important assets that will be coming in your examination will be plant and machinery and your computers and other things. So this 15% and 40% will be the most commonly used depreciation rate. So remember the key depreciation rates alone. Other than that, you can leave it. Akash Neil, in case of additional depreciation asset less than will the remaining, yeah, that's what we have worked out in this problem. In the problem, for the previous year asset, we are applying additional depreciation in the current year because in the previous year, the asset was used for less than 180 days. So the 10% is carried over. So this asset is for previous year 2021. That is why we are giving only 10% for this year. So that's how we are actually calculating additional depreciation. Raghavan, whether crossed check is digital? No. Account payee crossed check is only digital. Account payee check is only prescribed mode. A crossed check is not a digital. It's something like your bearer check only. So that's what is the difference between cross check and account payee check? Let's say if my name is Muthu, if someone is giving me a cross check, anyone in the name of Muthu can encash. If it is an account payee check, in that bank account, there must be an account holder named Muthu, only then you can encash. So account pay is very specific to that person having an account in that particular bank. So that only is considered as thing. So thank you all. So with that, I'll wind up today's session. We'll see in the next session on Monday. It will be purely problem solving with respect to business. If possible, we'll also try problem solving for some of the salary chapter. Some of you have appreciated the way I'm taking class or something. Thank you for each one for appreciating the way I'm taking. It really inspires me to take in a more better manner. So thank you for all the appreciations for each one of you who have appreciated me. And thank you for each one of you for listening the class so promptly for the whole period. So thank you all. We'll meet on 20th for problem solving session on PGBP and salary. Thank you all. With this, I'll wind up. Thank you for the wonderful session.